Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at therogueagent.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. Can I put more money into my life insurance policy after it is issued? Well, it depends. If you have a paid up additions rider, then maybe you can only put in an amount equal to the maximum annual payment limit, or whatever the contractual limit is for your policy. Some companies will call it an annual payment limit. Others will just call it a policy payment limit or a PUA limit, or they have different names for it. It's basically the same thing. So, and if you want to put more in above that dollar amount, then you have to go back to the company. You have to be underwritten for more insurance. And if you put in too much premium into a policy, then you violate TAMRA rules, and your policy could become a modified endowment contract. So, and usually those payment limits are pretty near the MEC limits. In some cases, the insurance company's annual payment limit is actually above the MEC limit. So I have clients who slam into the MEC limits before they hit their policy payment limit. It's just a quirk of the particular policy and the way it was designed and so forth. But in their funding pattern and whatnot. So it's possible that you run into those issues. So it might actually make more sense just to add money to just to start a new policy if you want to keep contributing money to a life insurance policy. All right. So how much life insurance am I allowed to buy? Is there a point at which they won't sell me anymore? Short answer is yes, there's a limit. So, how that looks, I guess how that's going to look at an insurance company is going to be, depending on their specific underwriting guidelines, but most companies have what they call a factor and that they apply to income. They'll do it either by if you're doing estate planning, they have a different table for this, but for income, if you're 18 to 40, you can usually buy up to 30 times your income, your gross income. If you're 41 to 50, you can buy up to 25 times your gross income. If you're 46 to 55, you can buy up to 20 times your gross income. If you're 56 years old to 60, you can buy up to 15 times times your annual gross income. If you're 61 to 70, it's 10 times your annual income. And then once you get over that, if you get like 71 and over, or sometimes it's like 72, sometimes 74 and over, it's based on individual consideration. Underwriting just has to look at it. They may or may not approve it at those older ages. It just depends. And again, the factor is a multiple of your gross income. So you're not going to tease out what your net income is. They're basing it off whatever gross is. So for example, if you're 45 years old and you make $100,000 per year gross, the insurance company will sell you at most 25 times your income, or $2.5 million of death benefit. Now that might sound like some people that might sound like a lot of money. 2.5 million is not a lot. It spends fast. It spends a lot faster than you would think it would spend. I mean, think about it this way, because consider what this is 2026. So consider what the median cost of a home is these days. 400, 500,000, somewhere in that range, right? And a high cost of living area, if you live in just a nice neighborhood, right? Homes can easily top $1 million. So $2.5 million death benefit is like, and that's maybe worth 2.5 homes, and in a nice area of the United States, maybe like 5 or 6 homes in an okay area of the United States. It sounds like a lot, but it's not. It really isn't. It's like, imagine buying like a home and like a vacation home, and you've spent like half of your death benefit already, right? And that's supposed to, by the way, that's supposed to last you in your entire life. Now, there's some people, they have a really hard time. I don't know. There's some, I've heard these, I don't want to get deep down in the rabbit hole of cognitive theories, but there's an idea out there that says that like some people are just incapable of thinking long term. They're just range of the moment. They're just incapable of it. Whether it's like permanently depressed and low IQ, or something happened to them at some point and they just, their brain just doesn't work right. I don't know. But I have met people who, for whatever reason, one reason or another, I don't know, can't or won't think in advance. So you tell them about, hey, you got to think about what's going to happen to you at age 85, because you might live that long, or 75, right? And they just, like, their brain their eyes just glaze over. Like, they just can't do it. There's just nothing there. But you have to think about that, right? If you're serious and you're buying life insurance, you have to think about what happens to me when I'm 60, 70, 80, 90, So, and $2.5 million, that's got to last you your whole life, right? So, I mean, it's not nothing, right? But it's not like $2.5 million this doesn't make you fabulously rich. So then people are like, oh man, my wife is going to kill me. My husband is going to want to kill me and take the insurance money. Like, really? It's not that much money. I mean, when you're talking, it sounds like initially like $2.5 million sounds like a lot of money, but it spends fast. It's not making anybody fabulously rich, and it's not supposed to. So relative to your income, insurance is not, the death benefit on insurance is not supposed to make you fabulously rich. What it's supposed to do is it's supposed to make you whole, or make your beneficiaries whole for a loss. And that has to be, you have to account for that over the course of your life, your whole life. So there's going to be, it's going to be enough money. It's going to be, enough money to live and maintain your standard of living, but it's not going to be like you can just throw money away. And that's not the point of insurance. Now, the cash values of insurance, again, they're designed to be a safety net. They're designed to provide capital for possibly other types of investment. They're designed to be there to protect you, to protect your savings. This is like safe money. It doesn't mean that necessarily all of your money goes into a life insurance policy, but you put money in there that you want to be safe and protected. There's going to be some in there and maybe some in other areas. Usually when people think about like, hey, I want to get rich and I want to have like lots of money, they think of owning a business or buying equities or something like that. When they think of protecting and saving their money, building a savings, like really starting savings, starting to save money, building up capital that you can then use for other purposes, that's life insurance. And it provides a safe, stable place for you to put money. And that doesn't mean that you can't put a lot of money in there. You can. I mean, if you can put theoretically millions of dollars into life insurance and have millions of dollars in cash surrender value, and maybe a couple $1 million in death benefit. And again, it's not going to be like we're living high on the hog or anything, but it can provide you with enough money to live off from comfortably for the rest of your life. And it's not Warren Buffett rich or Bill Gates rich or something, but it's enough that you would never have to worry about paying your bills. And that's what it's supposed to do. It's supposed to make it so that you take risk off the table. And if you don't have to ever worry about money ever again, that's taking risk off the table, right? And that's what it's supposed to do. All right, next question. I got a letter notifying me that my loan rate is changing. But I guess they mean policy loan rate. Why? What is going to happen to my policy loan? Okay, so first things first, don't worry, nothing is wrong. This is something that happens. It's pretty typical in the life insurance business. So most life insurance loans have a variable interest rate. Some carriers do offer fixed rate, like Guardian. But a lot of mutuals have switched over to a variable rate loan. Their policy loan rates might adjust periodically as interest rates change. So that's, they're just going to change when the Moody Corporate Bond Index updates, and your policy loan rate's going to change. So the thing is, for the past, up until I think 2022, it was I think it was 2021 or 2022, rates hadn't changed up to that point because they're pegged to Moody's Corporate Bond Index, and the rates have been basically stapled to the floor for so long. I mean, just like low interest rates, people just got accustomed to low interest rates. They thought 2% for a mortgage was normal, so people just assumed that policy loan rates would never change because they were stuck at 4%, 5% or whatever. But they do change. So now we're living in a very different rate environment. Moody's rates have been rising. They were rising, then falling, then rising again. So, carriers, I see this with my own policies. Carriers adjust their loan rates accordingly. So as the cost of money goes up, their loan rate goes up, and if rates dip, they come back down again. As for the cost of the loan, the net cost for policy loans tends to be very low, even with fluctuating policy loan rates. Because carriers that practice non-direct recognition tend to have their loan rates fairly close to the dividend rate, and they're not recognizing the loan to begin with, so dividends credit to the policy will be fairly similar to the interest paid on the loan. Not exact, but pretty close. For direct recognition loans, the insurance company is matching the loan rate exactly to the dividend rate on the collateral for those borrowed funds. So regardless, yes, interest cost on loans will probably rise a little bit from the original rate that you had in your policy. Does that mean more interest payments for the insurance company? Yes. They're going to be collecting more money, but does that mean more dividend payments for you? Yes. You're getting more dividends as a result. On the flip side, it means more dividends being paid. So in the end, it's all going to even out. So again, I wouldn't worry about it too much. But if you are concerned about making higher loan or interest payments, and you have an outstanding loan and you need to change your loan payments, or you want to review policy loans or something, contact your agent. If you're one of my policyholders, contact me. But yeah, I wouldn't worry about it. If you look at your life insurance policy and you see loan rates are changing, not a big deal. All things considered, your net cost of the loan shouldn't be outrageous, but again, look at your policy, see what it's actually doing. All right, I hope that helps. I was able to answer those questions satisfactorily. I enjoy these. Just keep them coming, and I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to
therogueagent.com. TheRogueagent.com.
And sign up for my daily email list.